Hey, Tom, it's very good to see you. Today we are discussing a 2022 market outlook. As we know already, 2022 is going to be a turnaround year following the stimulus and rally of 2020 and 2021. And the purpose of today's outlook isn't to predict, but to prepare. I know that you just spoke with Brookstone CIO Mark Diorio, and he said we can expect volatility and a correction, perhaps even an echo bear market, which is a correction of 20% or more. So, what are your thoughts on where we are?
Hi, Aaron. Great to see you. Thanks again. Happy New Year.
You too.
We had a nice conversation, Mark and I. As a matter of fact, John Amarano, my partner in our podcast, we just had Mark on as our first guest for the new year, as a matter of
Mhm.
fact, and we talked about a lot of this. Um, I have to agree with Mark. There's going to be a lot of volatility. There's a lot of unknowns going on today in the economy, in the world. And so people should be expecting a lot of volatility, a lot of ups
Right.
and downs, big movements in the markets, 2, 3, 5% per day in either direction. And we've been trying to prepare our clients for that type of scenario for really the last couple of months. One of the things that Mark said in our interview with him was that people shouldn't be fooled when there is a market correction. He said it's inevitable, and if you're caught with your pants down, so to speak, then it's because you haven't been paying attention. And so that's kind of been the focus of what we've been trying to do with our clients again for last 30, 60 days is really realign or readjust wherever we have to in order to prepare for it and also take advantage of it.
All right, well, let's drill down a little bit into more specifics there then. As you mentioned, the markets have already been volatile. The Fed has mentioned raising interest rates, and monetary policy is, of course, a key driver of asset prices so inflation doesn't run away. So, how do I address specifically these risks that we know are coming?
Well, I think part of it is making sure that you have your asset allocation or your investment strategies aligned for the times. We've, with the help of Mark and Brookstone and our active money managers, we've been moving people into, I think, a more conservative posture, relying a little bit more on short-term fixed interest rate products or vehicles. We've also been utilizing hedged equity ETFs, structured notes, all these things to try to help us create more of an income producing type of portfolio while we're in this equity up and down, this high volatility of the markets. Inflation is here to stay. We talked about this off camera before we started, right? When somebody earns a wage increase, when inflation stops or the markets get better, the bosses don't take that away.
Hmm.
We were talking about one of our favorite candies, the Hershey bar, right? Uh,
Shrinkflation.
Over the last couple of years, right?
Yeah.
Shrinkage. Instead of raising prices, they went from a 12-ounce bar to a 10-ounce bar to an 8-ounce bar. So that's not going to change again either. But that is inflation.
Hmm.
So we've been trying to create a protection mechanism where nothing is perfect. Even the strategies we utilize and the products and vehicles that we utilize aren't perfect. But what we are trying to do is create a management system for that downside.
Right. And so let's talk a little bit more about that downside, Tom, because as you've mentioned, if you are well positioned, there's even maybe an opportunity to take advantage of these downsides. I know you're a student of behavioral finance. So we know that during market downturns, people tend to panic and sell. What are we looking at here, and where do you think we are in this chart?
Right now, I think we're in the denial stage at this point.
Hmm.
I think there's a lot of people out there who, again, inflation, is just a momentary blip in the market, or there's so many things going on in the world today that they just think it's going to be over quickly because that's their experience from the COVID dip. Right.
Right.
The COVID dip lasted a couple of months and then all of a sudden the market skyrocketed, like you
Right.
said, in 2020 and 2021. but that's not the way real markets work. As a matter of fact, the NASDAQ and the Russell 2000 are technically in a bear market since their peak in November of 2021. And so that's how we have to prepare for this. I think people are a little bit more in the denial stage than anything else. But our clients, again, with the information that we're continuing to try to pump out to them, doing our client meetings, the interviews, podcasts that John and I do with people like Dean and Mark and Ed Slott, which was one that we recently did. We're trying to get people into the position that, like you said just a minute ago, where they can take advantage of what's going on in the market. Right? So we're not panicking, we're not panic selling, we're not panic buying, we're not doing any of that. We're watching the markets, we're positioning the portfolios, because there's always advantages or opportunities. Whether the market's high or the market's low, there's always opportunity. And if you're prepared to take advantage of that opportunity, then you're going to continually move forward.
Yeah, well said. Yeah, I always feel better after talking to you. Tom, if somebody is watching this and they would like maybe you to take an audit of where their portfolio is right now, or if they just have questions about the market, what's the best way to reach you?
The best way to reach us is our website or our email address, right? tjoconnell@internationalfinancial.com. You can see our website scrolling at the bottom of the page there. They could reach us at 973-394-0623 is our direct office line. And any one of those. I don't do social media. I mean, Twitter or Getter or any of that stuff, but we're on LinkedIn and we're on Facebook. So if people want to reach us through those programs, they can as well.
Easy to find. All right, Tom, thank you.
Thanks, Erin.